Viewers at home, you are welcome to my presentation on sales mix and quantity variances. Sales mix and quantity variances. If this is your first time of coming across my channel, or if you have not subscribed in the past, please don't forget to click on the red subscribe button and turn on the notification bell icon so that you'll be able to receive a notification message each time I drop a new video. If you are a returning subscriber, I say thank you and God bless you. So before I proceed to sales mix and quantity variances, I want to recap material mix and yield variances we have examined in our previous lecture. So we said material mix variance. We said material mix variance. Material mix variance. We said it is the revised standard quantity minus the actual quantity multiplied by the standard profit. Revised standard quantity. We said the revised standard quantity is equal to the standard quantity at actual mix. Standard quantity at actual mix. That is the revised standard quantity. We equally said that material yield variance. Material yield variance. We said it is the difference between the standard quantity based on actual production minus the actual quantity minus the revised standard quantity multiplied by the standard profit. That is material yield variance. In this presentation, our focus is on the sales mix and sales quantity variances. Sales mix and sales quantity variance. So we said we've considered the sales price and sales volume variance. We said total sales variance can be divided into two. Total sales variance will be divided into two. One, we have the sales price variance, and sales volume variance. And these two variances have been considered in our previous lecture. Try to watch my presentation on sales variances. So we said sales volume variance will equally be divided into two. We have the sales mix variance, and sales quantity variance. Sales mix variance and sales quantity variance. This sales mix variance is what replaces our material mix variance, and sales quantity variance is what will replace our material yield variance. So now in my presentation on sales price variance, I said sales price variance. I said it is the difference between the standard selling price and the actual selling price. Standard selling price minus actual selling price multiplied by the actual quantity sold. Standard selling price, SSP, standard selling price, ASP, actual selling price, AQS, actual quantity sold. That is sales price variance. I also examine sales volume variance. Sales volume variance. I said it is the difference between the budgeted quantity and the actual quantity sold multiplied by, and I've told you that there are two schools of thought as to the calculation of sales volume variance. We have the marginal costing schools of thought and the absorption costing school of thought. If it is marginal costing schools of thought, sales volume contribution, it will become sales volume contribution variance, and this becomes standard contribution. But if it is absorption costing, then it will be sales volume profit variance, and this becomes standard profit. So our focus in this presentation is to analyze the sales volume variance into sales mix variance and the sales quantity variance. We want to analyze it, our sales volume variance, into sales mix variance and sales quantity variance. So what do we mean by sales mix variance? Sales mix variance. Sales mix variance. A sales mix variance measures the effect on profit of changing the mix of actual sales from the standard mix. It measures the effect on profit or contribution. It measures the effect on profit or contribution. The effect, we said it measures the effect on profit or contribution of changing the mix of actual sales from the standard mix. That is sales mix variance. So remember, if it is sales mix variance, I will say sales volume variance is budgeted quantity minus actual quantity sold. And when we examine material mix variance, we say material mix variance, it is the revised standard quantity, and the sales volume variance is now using budgeted quantity. That means the formula will now become the revised budgeted quantity. So sales mix variance. So now I want to compute sales mix profit variance. Sales mix profit variance. The formula will now become the revised budgeted quantity. Revised budgeted quantity. Since the material mix variance, it is the revised standard quantity. And in terms of the sales volume variance, we did not use standard, we use budgeted quantity. So that means it will be the revised budgeted quantity minus in terms of the material mix variance, we have minus actual quantity. So in terms of sales mix variance, it will become actual quantity sold. So actual quantity sold. So we now have actual quantity sold multiplied by, since it is profit variance, so this becomes standard profit. Standard profit. Remember, we have standard profit here. So the same. You are going to have the standard profit. Then the second one is sales mix contribution variance. Sales mix contribution variance. The formula becomes revised budgeted quantity. Revised budgeted quantity minus actual quantity sold. Minus actual quantity sold multiplied by the standard contribution. Standard contribution. Standard contribution. Revised budgeted quantity minus actual quantity sold multiplied by the standard contribution. That is sales mix contribution variance. Remember, contribution is selling price, contribution margin, selling price less variable cost per unit. Selling price minus unit variable cost will give us the contribution margin. Number two, I want to examine sales quantity variances. Sales quantity variances. Sales quantity variances. Sales quantity variance variances. A sales quantity variance measures the effect on profit or contribution of selling a different total quantity from the budgeted total quantity. It measures the effect on profit or contribution of selling a different total quantity from the budgeted total quantity. So under this sales quantity variance, you can as well compute sales quantity profit variance. Sales, you can have sales quantity profit variance. Sales quantity profit variance. Remember, this is the variance that replaces material yield variance. And we said material yield variance, we said it is standard quantity based on actual production. Standard quantity based on actual production. Remember, our standard quantity in terms of sales, it becomes the budgeted quantity. So the standard quantity becomes the budgeted quantity in terms of sales. Actual quantity will be the actual quantity sold. Now the formula will look exactly the same thing. So this one will now become, since it is standard quantity, that means we are going to have budgeted quantity in terms of sales. Standard quantity based on actual production becomes budgeted quantity, minus revised standard quantity will now becomes revised budgeted quantity. Instead of standard profit, your standard profit, you still have your standard profit. So the formula becomes sales quantity profit variance will now becomes budgeted quantity minus revised budgeted quantity multiplied by standard profit. That is under absorption costing. If it is marginal costing, you have sales quantity contribution variance, which will now be budgeted quantity minus revised budgeted quantity multiplied by, instead of standard profit, we now have standard contribution. Standard contribution. That is sales quantity contribution variance. Sales quantity contribution variance. So I want to define the variables used in the formula. I want to define our variable. So the first variable I'm going to define is the revised budgeted quantity. Revised budgeted quantity. RSB, that is revised budgeted quantity. Revised budgeted quantity. How will you calculate your revised budgeted quantity? Revised budgeted quantity is equal to the standard quantity. Standard quantity multiplied by actual sales mix. Actual sales mix. So SQ stands for the standard quantity. Standard quantity. ASM, that is actual sales mix. Actual sales mix. So the product of the standard quantity and the actual sales mix will give us the revised budgeted quantity. Revised budgeted quantity. BQ represents the budgeted quantity. Budgeted quantity. Budgeted quantity. That is our BQ. Budgeted quantity. So those are the variables. AQS. AQS. That is actual quantity sold. Actual quantity sold. These are the variables I used in the formula. So I want to take a work example. This question is obtained from Kepler ACCA study test. Kepler ACCA study test. Performance management. F5. So the question. Cabco operates an absorption costing. So since it is absorption costing, the Cabco operates. That means you are going to have the standard profit. There will be no contribution. Operates an absorption costing system and sells 3 products B, R, and K, which are substitutes for each other. Now, the following standard selling price and cost data relates to these 3 products. We have the product, we have unit selling price, we have direct materials per unit, we have direct labor per unit. You have for B, the selling price is $14. Direct material for B, 3 kgs at $1.80 per kg. Then we have direct labor, which is 0.5 hours at $6.50 per hour. We have R, $15 is the selling price, and the direct material 1.25 kgs at 3.28 per kg, and direct labor 0.8 hours at $6.50 per hour. Then we have K, $18 is the selling price, direct material 1.94 kgs at $2.50 per kg. $2.50 per kg, and direct labor is 0.7 hours at $6.50 per hour. So those are the cost detail. You have the budgeted fixed production overheads for the last period was $81. This was absorbed on a machine hour basis. The standard machine hours for each period and the budgeted levels of production and sales for each product for the last period are as follows. We have product B, R, and K. The standard machine hours. We have standard machine hours per unit, 0.3 hours, 0.6 hours, and 0.8 hours. Budgeted production and sales in unit 10,000, 13,000, and 9,000 for B, R, and K respectively. Actual volumes and selling price for the 3 products in the last periods were as follows. That is actual information. So meaning that this information are for actual. So we have actual. We have product B, R, and K. Actual selling price per unit is $14.50, $15.50, and $19.00 for B, R, and K respectively. Actual production and sales in units 9,500, 13,500, and 8,500 for B, R, and K respectively. Required. Calculate the following variances for overall sales for the last period. For overall sales for the last period. Number 1 is sales price variance. Number 2, sales volume profit variance. Number 3, sales mix profit variance. Number 4, sales quantity profit variance. So, solution. So, number 1, you want to compute sales price variance. Sales price variance. We said sales price variance, sales price variance. We say it is the difference between the standard selling price and actual selling price multiplied by actual quantity sold. Standard selling price minus actual selling price multiplied by actual quantity sold. And there are 3 products. The products are B, R, and K. These are the 3 products. You want to compute the sales price variance for the 3 products. So now let's put the product. We have B, R, and K. What is the standard selling price for the 3 products? You go back to the information where you have information about the standard. So the standard information. You were told the standard following standard selling price and cost data relate to these 3 products. These are the standard selling price. 14 naira, 15 naira, and 18 naira. $14, $15, and $18 for B, R, and K respectively. So we have standard selling price $14, for R $15, and for K $18 minus actual selling price. You go back to where you have information about actual selling price per unit. Actual selling price per unit 14.5, 15.5, and 19.00. 14.5, 15.5, and 19.00. So for B, we have $14.5. Then we have $15.50 and $19.00. Multiply by the actual quantity sold. Actual quantity sold. AQS stands for the actual quantity sold. Now, the actual production and sales. Actual production and sales in units. For B, 9,500, 13,500, and 8,500. 9,500, 13,500, and 8,500. So for B, actual quantity sold is 9,500 units, then 13,500 units, and 8,500 units. So, what is therefore the sales price variance? The sales price variance for B, if you have 14 minus 14.5, that will give you 0.5. 0.5 times 9,500, that will give us $4,750. $4,750. If you have $4,750 and the actual selling price exceeds your standard. That's to show that it is a favorable variance. For R, 15 minus 15.5 will be 0.5. 0.5 times 13,500, and that will give us 6,750 favorable. It is favorable because actual selling price exceeds the standard. For K, 18 minus 19 will give us 1. 1 times 85, then you have 8,500 favorable. Therefore, our total sales price variance. Sales price variance, you now sum up the three. You sum up the three. So when you sum it up, then the total will be $20,000. $20,000 favorable. That is 4,750 favorable plus 6,750 plus 8,500. That will give us $20,000. That is the requirement 1. The second requirement, sales volume profit variance. That is the requirement 2. Sales volume profit variance. Sales volume profit variance. That is number 2. Sales volume profit variance. I've told you that this is the difference between the budgeted quantity minus actual quantity sold multiplied by the standard profit. Sales volume profit variance, the weight should be standard profit. But our standard budgeted quantity is given in the question. Budgeted quantity sold is given. You were given the budgeted production and sales. Budgeted production and sales is given. Then you are equally given the actual quantity sold. You are given the actual quantity sold to be actual production and sales in units 9,500, 13,500 and 8,500 units. But you are not given the standard profit. You are not given the standard profit. Therefore, you will need to calculate the standard profit. And what is standard profit? You know, your profit is revenue less cost. Now, let's compute our standard profit. Working 1. Standard profit. If profit is revenue less cost, and 3 products are involved, we have B, R, and K. These are the 3 products. In dollar. Now, what is our, since it is standard profit, that means information you are going to use will be from the standard, not actual. You are going to use the information from the standard and not actual. Therefore, what is our, you are starting with standard selling price. Standard selling price. Let me put standard at the top. So meaning that you are using information from standard. So our standard selling price. Standard selling price. Our standard selling price is given. Standard selling price is given. The following, you were told that following standard selling price and cost data relate to these 3 products. That means these are information from standard. You are given the products B, R, and K. Unit selling price 14, 15, and 18. So our standard selling price are $14, $15, $15, and $18. From that selling price, you less variable cost. Our variable costs include direct materials. You are given direct material per unit. So we have direct materials. Direct material. For B, the direct material cost for B is 3 kgs at 1.80 per kg. 3 kgs at 1.80 per kg. So that is the direct material cost. So 3 kg at $1.8 per kg. So 3 times 1.8. 3 times 1.8, that gives us 5.40. So we have 5.40. You know you want to less those costs, so that's why I put it in braces. For R, direct material cost for R is 1.25 kg at 3.28 per kg. For R, so we have direct material 1.25 kg. 1.25 kg at 3.28 $3.28 per kg. So 1.25 times 3.28, then we have 4.10 $4.10. For K, for material K, you have 1.94 at 2.50. 1.94 times 2.50. So that will give us 1.94 times 2.50. Then we have $4.85. $4.85. That is direct material. So you want to less cost. You want to less total cost per unit. Aside direct material, we have direct labor. Direct labor is 0.5 hours at 6.5, 0.8 hours at 6.5, and 0.7 at 6.5. So that is direct labor. So we have direct labor. So you were given 0.5 hour at 6.5. 0.5 hours at 6.5 $0. So if you have 0.5 times 6.5, then you have 3.25. 0.5 times 6.5. 5 times 6.5. Then you have 3.25. That is direct labor. For R, you have 0.8 hours at 6.5 $5 per hour. That gives us 5.20. Then for K, we have 0.7 times 6.5. 0.7 times 6.5. And that will give us 4.55. 4.55. So that is for the purpose of calculating our standard profit. Now, remember all the costs we have considered so far. they are purely variable in nature. No fixed cost has so far been considered. So, and what we need is not contribution. If it is contribution, then you will have just subtracted the variable cost from our selling price to get our contribution. Remember, it is profit we need, not contribution. So that means you will need to consider your fixed production cost or fixed cost. So now let's go back to where we have information about fixed cost. Budgeted fixed production overheads. Budgeted fixed production overheads for the last period was 81,000. This is budgeted fixed cost. 81,000 for the period. $81,000. This was absorbed on machine hour basis. This cost was absorbed on machine hour basis. That means you will need to compute machine hourly rate. And remember that overhead absorption rate is budgeted overheads over budgeted level of activity. Our level of activity will be machine hours. Our level of activity will be machine hours. That means overhead absorption rate will be budgeted fixed overheads over budgeted machine hours. So this is the budgeted fixed overhead. Then what is our budgeted machine hour? The standard machine hours for each period and the budgeted levels of production and sales for each product for the last period are as follows. You are given product B, R, and K. The standard machine hours. This is the standard machine hours. Remember, I've told you that a standard is a unit cost concept. This is for a unit. To produce 1 unit, 1 unit of B, 0.3 hours will be required. Therefore, how many hours will be required to achieve the budgeted production of 10,000? Then you have 0.3 times 10,000. For R, 0.6 hours times 13,000. And for K, 0.8 hours times 9,000. So now let's compute our budgeted machine hours. Budgeted machine hours. Budgeted machine hours. 3 products are involved. We have product B, product R, and K. The budgeted machine hours for B is 0.3 and budgeted production is 10,000 units. This 10,000 is in units. So you will have 0.3 times 10,000. And for R you have 0.6 times 13,000. And for K, 0.8 times 9,000. So now let's do that. For B, 0.3 times 10,000 units. No, it's 0.3 hours. Let me put R. 0.3 hours times 10,000 units. And that will give us 3,000 hours. This is machine hours. Machine hours. For R, you have 0.6 hour times the budgeted production is 13,000. So what will be the budgeted machine hour? 0.6 times 13,000. Then we have 7,800 machine hours. 7,800 machine hours. For K, you have 0.8 machine hours times the budgeted production is 9,000 units. And that will give us 0.8 times 9,000. Then we have 7,200 machine hours. When you sum it up, 7,200 plus 7,800 plus 3,000, then you have 18,000 machine hours. 18,000 machine hours. Remember our fixed overheads absorption rate. Fixed overheads absorption rate and that will be budgeted fixed overheads over budgeted machine hour. Budgeted machine hours. Our budgeted fixed overheads. Budgeted fixed overheads is given to be 81,000. Budgeted fixed production overheads for the last period was 81,000. So you have 81,000. $81,000 divided by 18,000 machine hours. So that will give you have 81,000 divided by 18,000. Then you have $4.5. $4.5 per machine hour. That is the rate per machine hour. So you are now going to absorb your fixed overheads to the product on machine hourly basis. So you have fixed overheads. For product B, how many machine hours will be required to produce a unit of product B? To produce a unit of product B, you will require 0.3 machine hours, and to produce a unit of product R, you will use 0.6 machine hours, and to produce a unit of product K, you will require 0.8 machine hours. So now let's use those hours to absorb our fixed overhead. Remember, our fixed overhead absorption rate is $4.50. So now let's absorb our fixed overheads to the product. So for this now, how many machine hours? For B requires 0.3 machine hours. 0.3 hours times 4.5. Remember, our fixed overhead absorption rate is 4.5. 0.3 times 4.5 will give us $1.35. $1.35. Therefore, R, how many machine hours? 0.6 machine hours is required to produce a unit of R. 0.6 times $4.5. Remember, our fixed overhead absorption rate is $4.5. So if you have 0.6 times 4.5, that will give us $2.70. So we have $2.70. For K, to produce a unit of K, 0.8 machine hours is required. 0.8 times 4.5. Remember, our fixed overhead absorption rate is 4.5. 0.8 times 4.5, then you have 3.60 per unit. Now, when you deduct all the cost, so now we have the standard profit. Standard profit. $14 minus 5.40 minus 3.25 minus 1.35. Then we have $4. This is $4.00. That is the standard profit. Then 15 minus 4.10 minus 5.20 minus 2.7. Then you have $3.00 per unit. That is the standard profit. For K, 18 minus 4.85 minus 4.55 minus 3.60. That gives us $5 per unit. That is the standard profit. Now we've got our standard profit. Now you can now go back to the requirement of the question. In the question, what we have to calculate is sales volume profit variance. Sales volume profit variance. Don't forget, I've told you that sales volume profit variance, I said it is budgeted. Sales volume profit variance. That is budgeted quantity minus actual quantity sold multiplied by the standard profit. So our sales volume profit variance, that is number 2, sales volume profit variance, and that is budgeted quantity minus actual quantity sold multiplied by standard profit. So we now go back to the question. What is our budgeted quantity? The budgeted quantity as given in the question, budgeted production and sales, 10,000 units, 13,000 units, and 9,000 units. Everything is in units. 10,000, 13,000, and 9,000 for B, R, and K. So we have B, R, and K. For B, budgeted production is 10,000 units. For R, 13,000 units. And K, we have 9,000 units. That is the budgeted production. Minus, that is our budgeted quantity. Minus actual quantity sold. What is our actual quantity sold? The actual quantity sold, we have 9 actual production and sales units. Actual production and sales unit, 9,500, 13,500, and 8,500. So we have 9,500 units, 8,500 and 13,500 units, and 8,500 units. Multiplied by the standard profit. Our standard profit has been calculated. Our standard profit for B is $4. Then we have $3 and $5. So we have $4, $3, and $5 as calculated above. So 10,000 minus 9,500 will be 500. 500 times 4, that will be $2,000. $2,000. This is an adverse variance because you budget to sell 10,000 and you actually said 9,500. I mean, you have sold less than budget. You sell less than budgeted for. Since you budget to sell 10,000, you actually sell 9,500. What you sell is not up to your budget. That is an adverse. It's an adverse variance. 13,000 minus 13,500. You sell more than budget here. This is favorable. Times 3. This will be 500 as well. Times 3. And that will give us $1,500. This is favorable. Because you sell more than your plan or estimate. 9,000 minus 8,500. That will also be 500 times 5. And that will be 2,500. But here you sell less. That is an adverse. So you have 2,500 adverse. Now we have 2 adverse. 2,000 plus 2,500 adverse. That will be 4,500. 4,500 minus 1,500 you'll be left with, because adverse is more than the favorable. The favorable is 1,500. Then you'll be left with 3,000 adverse. 3,000 adverse. That is sales volume profit variance. Sales volume profit variance is 3,000 adverse. So, having computed our sales volume profit variance, then we go to the requirement 3. Then in our requirement 3, you are to compute sales means profit variance. Sales means profit variance. That is the 3rd requirement. Sales means profit variance. That is the 3rd requirement. So remember I told you that to compute the mixed variance, I've given you the formula. I said it is the revised budgeted quantity. So the formula is for calculating sales mixed profit variance. Sales mixed profit variance. I said that is the revised budgeted quantity minus actual quantity sold multiplied by standard profit. Standard profit. Since it is sales mixed profit variance, but if it is contribution, then you are going to have your standard contribution. Now, what is our revised budgeted quantity? Don't forget there are three products: product B, product R, and K. Now, revised budgeted quantity. Our budgeted quantity for B, R, and K, we have 13,000. We have 10,000, 13,000, and 9,000. 10,000, 10,000 units, 13,000, and 9,000. When you sum it up, the total will be 32,000 units. 9 plus this is 32,000 units. That is the total. The total budgeted quantity. Now, you also sum up your total actual quantity sold. Total actual quantity sold. Total actual quantity sold. You go back to the question. What are our actual quantities sold? Actual production and sales, we have 9,500, 13,500, and 8,500. You sum it up. Total actual quantity sold, we have 9,500 plus 13,500 plus 8,500. When you sum it up, 9,500 plus 13,500 plus 8,500. The total is 31,500 units. 31,500 units. Now, you are now going to apportion that 31,500 on the basis of this proportion to get your revised standard quantity. Then for B, you have 10,000 out of the total of 32,000 times the total actual quantity, which is 31,500. Don't forget, these are the budget. It is the budget we sum up here. So, this will be, when you apportion this, then this one, 13,000 out of 32,000 times 31,500. And this one will be 9,000 out of 32,000 times 31,500. That is our revised budgeted quantity. Revised budgeted quantity. For B, for product B, we have 9,843.75 units. That is our revised budgeted quantity. For R, we have 12,796. 12,796.875 units. 875 units. For K, we will have 8,859, 8,859.375 units. 375 units. That is our revised budgeted quantity. Having calculated our revised budgeted quantity, you can therefore calculate our sales means profit variance. Sales means profit variance. So remember, sales means profit variance. The formula is, so sales, that is 3. Sales means profit variance, and that is the revised budgeted quantity minus actual quantity sold multiplied by the standard profit. So, and there are 3 products involved, B, R, and K. There are 3 products involved. Product B, R, and K. Product B, product R, and product K. Revised budgeted quantity for B, we have 9,843.75, 9,843.75 units. For R, we got 12,796.875 units, and for K, we got 8,859.375 minus actual quantity sold. You go back to our revised budgeted quantity is as calculated above. Then we also need actual quantity sold. Actual quantity sold. And what is our actual quantity sold? You go back to where you have information about actual quantity sold. Actual production and sales in units: 9,500, 13,500, and 8,500 for B, R, and K respectively. So our actual quantity sold now. Actual quantity sold, we have 9,500, we have 13,500, and 8,500 for B, R, and K respectively. Multiply by the standard profit. Standard profit. We have computed our standard profit. These are the information about the standard profit. These are our standard profit. This is the working. We got $4, $3, and $5. So we have our standard profit. Standard profit: $4, $3, and $5. So sales means profit variance. Sales means profit variance. So what is our, if you subtract this, multiply by 4, we have 1,375. 1,375.00, and this is an adverse because the actual is less than planned. It's an adverse variance. 12,796.875 minus 13,500, then multiply by 3, you have 2,109.375, and this is favorable because the actual is more than planned, so it is favorable. For K, 8,859.375 minus 8,500, then multiply by 5, so we have 1,796.875 1,796.875. And this is an adverse variance because this exceeds this. So you plan to sell this and you sell lesser than planned. Is an adverse variance. So when you sum it up, let's add the two adverse and minus the favorable. The sum of the adverse exceed the favorable. Sum of the adverse exceed the favorable. So by 1,062.5 adverse, and that is sales missed profit variance. Sales missed profit variance. 1,062.5 adverse. So that is the requirement 3. Then requirement 4. You are to compute the sales quantity profit variance. Sales quantity profit variance. Sales quantity profit variance. That is requirement 4. So we have sales quantity profit variance. I've told you that sales quantity profit variance, and that is budgeted quantity. Budgeted quantity minus revised budgeted quantity. Revised budgeted quantity multiplied by the standard profit. Standard profit. And there are 3 products. 3 products involved. We have B, R, and K. Product B, product R, and product K. So, our budgeted quantity. You go to where you have information about budget. Budgeted quantity, we have 10,000, 13,000, and 9,000. 10,000, 10,000, 13,000, and 9,000. 10,000 units, 13,000, and 9,000 units. Minus revised budgeted quantity. Our revised budgeted quantity have been calculated, and we got 9843, 9843.75, 12796.875, 8859.375. So, revised budgeted quantity for B, 9843, 9843.75. For R, we have 12796, 12796.875. 875. And for K, we have 8859, 8859.375. 375 as calculated. Multiplied by the standard profit. Our standard profit as calculated, we got $4, $3, and $5 from our earlier calculation. The standard profit, which was $4, $3, and $5. So we have $4, $3, and $5. Now, 10,000 minus 9,843.75 multiplied by 625. We got 625, and multiplied by 4, we got 625 dollar adverse. If you subtract this, multiply by 3, then we got 609.375 adverse. 609.375 adverse. Then if you subtract this, multiply by 5, we have 703.125. 703.125 adverse. Everything is adverse. So you sum it up, you have 1,937.5. 1,937.50 adverse. 1,937.5 adverse. This is sales quantity profit variance. Sales quantity profit variance. So that is the end of the solution to the question. Please be expecting more from me. My next lecture shall cover the composition variance and productivity variance. That is labor composition variance, or team composition variance, and team productivity variance. I will as well consider the work back from variance analysis. Work back from variance analysis. If you have not subscribed, please don't forget to click on the red subscribe button so that you will be notified when those videos and my upcoming videos are ready. Thanks.